today I'm joined by Tristan Waine, the inaugural episode of the Buyback pod. Welcome, and it's a pleasure to have you on, mate.
Thank you for having me. It's a pleasure.
We'll get stuck right in. As much as you're willing to, can you tell us a little bit about yourself and about your background personally?
Absolutely. So, I'm 26 years old, and I grew up on the south coast of New South Wales. After leaving high school, I went into university to do accounting and financial planning, and I was there for 4 years. In my last year of university, I got a full-time job as an accountant. And around about the same time, the Royal Commission for Financial Advice was happening. So my financial planning major, I decided it was too risky and this went full into accounting. And then straight after I left uni, I just started working full-time and studied CPA on the side, which is Certified Practicing Accountant. It's basically a post-grad degree. And 4 years later, here we are.
So how was the COVID period? How did you find that with, relatively coming out of work and coming into the workforce?
Yeah, that was really interesting because, I was already probably about 18 months into work at that stage. But what was interesting was we had never done any remote work before, and we had to adapt to that. But at the same time, the government was putting out all of these new, basically grants, like Job Keeper and Cash Flow Boost and various other grants. But but they don't administer them themselves. They actually put all of the work on top of the accountant. So what you think might not be a busy time is actually extremely busy for us. So yeah, that was rough. Working from home, having to deal with the sort of transition to all the systems. But at the same time, it's busier than usual because we're doing a lot of administration for all these new grants.
Cool. So you've obviously got the accounting background. So, could you tell us a little bit about how you became, interested in finance and investing, and maybe there was some lap over there?
Yeah. Okay. So probably I started my part-time job at McDonald's when I was 14. And when I was making nothing impressive, but that pocket change, I was not spending it as fast as I was earning it. So what I was doing was just putting cash into my parents' brokerage account, and it was getting invested. That happened for about 4 years before I left high school. And then I took ownership of that account to find out that the performance had been not good at all. Not bad, but not good at all. It's a lot of Telstra shares, AMP, which subsequently, what happened? AMP got destroyed. Yeah. So I took over that account, and the next 2 years, 2015, 16, those years where I wasn't really actively investing. So that was just kept invested in what was there already. But when I got to 2017, I actually took ownership because that was the third year of my university degree, and I was actually starting to do some finance subjects and get interested in it. So I took over that account, made some pretty silly mistakes in the first year, but I didn't have much money, so it was okay. And then, sort of compounded from there. I read a lot of books, a lot of podcasts, learned a lot on the way. And here we are, almost 6 years in.
I think it's been a pretty good run, at least since I think the period you mentioned that you started taking things seriously, I think was 2017. Was that around that time? Yeah.
Yeah, it was specifically like August 2017.
We'll get into some of the open source questions in just a bit because there were quite a few on the first trip around. But could you tell us a little bit, about your general investing philosophy, and perhaps how that changed from those early years to kind of where you are now?
Yeah. So when I first started, it's always been sort of like a value investing skew. I never really got into trading or like technical analysis or that type of thing. It's always been sort of buy a dollar for 50 cents. And I took that very literally at the start. So I was doing a lot of trading activity. I would get a small bump and be like, this has gone up closer to intrinsic value. And then I'd sell it and move on. So yeah, I did that quite a bit at the start. Too much, but yeah, sort of developed over time with podcasts and books. Definitely helped a lot, and just general experience. It's sort of developed into a much more mature. Like I've definitely like raise the bar on what's acceptable as an investment. And it's still an ongoing change. I definitely, no one will settle in their ways. But yeah, more recently, I suppose it would be characteristic of somewhere in the middle between like the Graham type style investor and the long-term Buffett stage 2 type of Buffett investor.
When you say you're raising the bar, I know that you've put out a piece recently where you were talking about the hurdle rate, and there might even be a brand change in there, but the hurdle rate that you're looking for in your investments is probably a little bit higher than you had in the past. And in terms of that hurdle rate, is that cheapness, business quality, bit of both? How do you think about that?
Yeah, well, I think just generally I have like a don't take any sort of style as a specific style as like the main thing that I focus on. I just try to be as open as possible. But in saying that, I don't think there's specific types of companies that I'll ever touch, like overly cyclical type of companies. But yeah, just generally like the hurdle rate thing, that is mostly in reference to just sort of a discount rate. And that came from Mark Leonard, Constellations. He talks about they don't move their hurdle rates. They keep it set and fixed. So you're always comparing investment, but the minimum investment needs to meet the hurdle rate. So, above the hurdle rate, you're comparing investments, but below the hurdle rate, you're not investing at all. So that's how the hurdle rate works.
Cool. And so, on this journey, I know you mentioned some podcasts and, maybe even some books. Is there anything that really steps out in terms of, books or mentors or, even, interviews, that kind of thing, which has really guided you along this, journey?
Yeah, so I think like the first major mentor for me was John Greenblatt, and a lot of people say the book, there's the Magic Formula. That one was particularly sort of that's still to this day, that's the type of investing that I'm trying to do, but like not in a formula way style. But there's another book which is specifically about special situations. The name escapes me at the moment, but
it's not the You Could Be a Stock Market Genius.
Yeah, that's it.
Okay.
That one is to a lesser extent, that one is also definitely helped me develop where I am today. But also, I think the single most influential thing was actually the Focus Compounding podcast. So they are a small investment fund in Texas, US. And they put out this podcast. They've been doing it since 2017 or 2018. So similar time frame to what I've been doing. And along the way, I sort of listened to every single podcast that they put out. I picked it up early and then I just kept going with it. Like I think I would have been, within their early subscribers to their podcast. So, I sort of traveled along the journey with them, learned a lot. So that was good, very helpful.
And I might put some links to their stuff in the show notes as well. But okay, so you've got the kind of philosophy that you're working towards at the moment. But one of the questions that was repeated multiple times in the Twitter thread comments was, how do you go about generating your ideas?
There's no secret source to this. It's really sort of like a lattice work of sources. So, you've got, if you follow my Twitter account, I retweet write-ups all the time. Every single time I see a write-up, I'll retweet it. So my feed at this stage, except for a few of my own posts, it's like predominantly retweets of other people's write-ups. So I use it as sort of a bit of like a deal flow type of situation. But also screeners, everyone knows about screeners. There's fund managers, other investors that you like. And more recently for me, I sort of went on this exercise of dialing in on like a circle of competence. And we might talk a bit on that later. I think there's a question about that. But what I did was because you can get like global list of stocks and sort them by industry. And I've pretty much just been going through as many stocks as I can and picking up any of the ones that might sound like I might be able to understand them, but like better than most. And that's culminated in a pretty long list at this point. But that's an ongoing process.
And in terms of the circle of competence, I know we've got some questions about this, so it's probably a good juncture to talk a little bit about it. From what I've read and followed you on Twitter, you're predominantly, interested in sort of professional services industry, which I believe, is where you work as well. Is that broadly, right? Yeah,
that's intentional. Just sort of experience as an accountant, and then also like background in financial advice as well. That's the sort of wheelhouse that I've chosen to focus on, because I think I can sort of, if I focus on that area, I'll learn a lot quicker, and get sort of much better in that specific area. So yeah, that's the area I've chosen. And pretty much all of my ideas nowadays are just firmly within that narrowly defined circle.
And so, with what you've been public about, there's been some pretty terrific performance since you've been taking things a bit more actively, since that 2017 period. Do you think, anything has specifically driven that performance? Is it, staying within the circle of competence? Is it, something else? How do you think about that?
Yeah, yeah, to a large extent, I think most of my best performers have actually been the companies that I've known best. So the best dollar terms performance was actually Kelly Partners, which is
and did you work there earlier in your career? Was that
full disclosure, I did work there from the start of 2021 to the end of 2022. So yeah, I worked there for 2 years, but I did invest back in 2019, so well before I started working there. Yeah, and I think that was definitely a case of, I work in the industry. I know what I'm sort of looking at here. I don't know why it's been priced at this price, because we're as busy as ever. So there was that sort of situation. And then I dug more into it. I'm like, okay, hold on. There's something to it here. So decided to make an investment.
Very much like that Peter Lynch approach, invest in what you know.
Yeah, and I really wanted to cultivate that type of because there's been other investments where it was exactly the same situation. So like my second best winner is actually Class Limited, which is self-managed super fund software. So same thing. I was a daily user of Class, so I knew how good the software was, and it was it's just another one of those things where, hold on a second, there's something to it. Why is it being priced the way it is? And
do you think some of those bombed out valuations, especially around COVID, pre-COVID, was there any overlap there with because I know some of these companies are Australian. Do you think anything had to do with the Royal Commission into financial services that kind of played into some of these as well?
Not for these two in particular. So Class is, if anything, the Royal Commission should have helped Class, because it was all about these industry, the retail super funds, I should say, getting bombed out and just overcharging people. Self-managed super funds is a fixed fee. You do it all yourself. You keep the cost as low as you possibly can. So if anything, that was a tailwind for that. But Kelly Partners is just, there was nothing to do with the business. So that's just straight up tax compliance work. So, COVID was anything but impactful on that business. It was actually the opposite. Yeah.
A decent circle of competence there. How do you think about diversification in terms of, how you're picking your investments? Because you are, from what I understand, pretty concentrated as well.
So I think for the most part, besides specific areas of what I'm looking at, most of what I look at is actually like anti-cyclical. It's not cyclical at all. It's just sort of day to day. This is, business as usual. It doesn't really suffer from cyclicality. There is some things like I have invested in a corporate finance business in the UK, and that was pretty obviously cyclical. So definitely tried it. But there's also counter-cyclical parts of professional service as well. So insolvency practitioners is a good example of that. When there's more zombie companies, those firms get busier. So I think just generally it's not cyclical, but there is parts of it. But yeah, usually I look at it from a type of like a client-driven. What's their motives? Why would they use the business service? And what type of market would they use it more? What type of market would they use it less? Yeah.
So purely ground up analysis.
Ground up,
specific businesses. So
yeah, no top down at all.
Yeah.
I definitely do think about how do the companies in the portfolio relate to each other. Definitely don't want to take all of the same risk. Try to get as close to the as Ray Dalio would say, the holy grail of diversification.
And so, one of the other questions that was had quite a few ticks on it was, the circle of competence. Are you looking to sort of expand this? Are you looking for opportunities to go outside of it? How do you think about that?
I think at this stage there's more than enough where I'm at. So it's really just sort of keep going until I've saturated it. But at this stage, from what I've identified, it'll take me a long time to get through what I've cooked up. So no real plans to extend.
And so, I did mention before, and I had seen that you do run a fairly concentrated portfolio, and you might have actually taken steps more recently to kind of even focus the portfolio even more. How do you think about the number of names that you have in your portfolio?
Yeah, so this originally came from a podcast that I heard from Focus Compounding, and they had this sort of idea where you would, when you're in a low capital amount, you invest more capital in a single idea because your cash flow will allow you to quickly diversify. So that's basically what I did for the last 3 years. I was saving a certain dollar amount, and it would only take me 6 to 12 months to buy another position. So, you might have looked at my account like it's very, very concentrated, but in 2 years it'll be twice as many positions as it is. So that type of thing. And I kept going with that until I hit about 5 or 6 positions. And then I changed tune because I was getting to the stage where cash flows weren't as material. So shifted to a more traditional type of management of the portfolio. And then I got a little bit excited and started adding in positions a little too fast. So more, only just probably a few months ago now, I just decided to pare that back a bit to what I'm comfortable with personally.
Mm-hmm.
So for me, that's sort of like 5 or 6 positions that I can know pretty well. And it differs with everyone. That's just, I found any more than that, I didn't feel comfortable.
And when you say that you didn't feel comfortable, was that you don't think you could keep up with all the developments that were happening and more than that, or you didn't feel like you could have conviction in that many positions?
Yeah, a combination of both of those.
Mm-hmm. The only reason I ask is because I have the exact same thing.
Yeah. So there's like a saying where you say every single idea you make, the next idea is incrementally worse. Yeah. So, you rather invest in your 5th best idea than your 15th, that type of thing.
Yeah. And when you've got a pretty good, handle and, a specialization, it's not like you feel like the incremental opportunities aren't, as good.
Yeah, that's right. And we're all like public market investors, so you can quickly reverse your decision. It's not hard.
Mm-hmm.
Yeah.
So I was going to sort of split up a couple because people are really interested in the, the individual names that you held in the portfolio or you have held in the portfolio. So it's going to have like one, success and then maybe one challenge. Everyone wanted to know about Kelly Partners Group. So, could you talk us through the investment and, what changed? Because I think you might have sold down the position or fully exited recently.
Yeah, so I'll start with, why I made it in the first place. And it's really like they sort of, the background about the business is obviously it's an accounting firm in Australia. When I first invested, it was fully saturated, and in New South Wales, there was no firms in Victoria or Queensland. And it was all around, like obviously I worked at Kelly Partners nearby, but there was like a pretty saturated in the Sydney area. So I was pretty well informed about all the offices. So it really didn't take too much effort to sort of understand, because I used to drive past the Wollongong office every single day, or their old office at least, since they moved their office. But it was very much the same sort of work that I was doing. So tax returns and financial reports on an annual basis. So compliance work, the odd client interim financial statements as well. Yeah, sort of, tax returns, accounts, GST, pay-as-you-go holding, super, all that type of stuff. Very familiar with that. So the underlying business I was completely comfortable with. But what they do specifically is they have this really strong partner offer. So specifically for succession. So I think Brett has explained this so Brett being the CEO of the company, he has explained this in the podcast that what they do is like small leverage buyouts. It's kind of that's the way to put it for them. Small leverage buyouts for succession. So specifically aimed at succession. Because the firm that I was working in, for example, the vendor there was 75 and he's stuck around for a while. But there was partners coming up and replacing the equity ownership. So what they do is they pull it, they come in before the vendor retires, buys him out mostly, and then either they buy back in a portion of it or new partners buy in a portion. So it's not just like Kelly Partners always owns 51%, but the other 49% is not just owned by one guy. It's usually several people, and it's ebbs and flows. It depends. They can literally be as many people as they want it to be. pretty much.
So that's kind of like the business background, and it's and sort of their value offering in terms of I guess you would call it a roll up. Is that right? They're rolling up small
No,
accountancies. No.
yeah, I guess they really hate the term roll up. So
Yeah. Okay.
if you if you say it's a roll up, oh, don't say that. But
Okay.
yeah, but in effect,
Yeah.
really like that. What they're doing is consolidating the industry. But
Mhm.
where it differs to a roll up is instead of acquiring 100% of the firms, they're sharing ownership. So really, they're more of a business partner.
Mhm.
Hence the word Kelly Partners. What they tend to do is they acquire a controlling stake, and then they have the right to exercise a vote for the other partners because they have the controlling stake. Because when the partners can't make a decision, which is rare, when they can't make a decision, Kelly Partners can make it for them.
So this is sorry. This is on the individual accountancy level. So the partners
Yeah,
in a
that's right.
particular.
Yeah, so they have this controlling partnership stake, and because they have the controlling stake, then they can make decisions for the partners on their behalf. But at the same time, the partners sharing ownership on the other side, because it's structured as a partnership and not as a separate legal entity. They have joint and several liability. So if the partnership's debts are, everyone's liable for the debts. They don't just have, you can't just leave as a partner when there's all of your liabilities are sitting in there. So, they share, they share, they share risk, which is very important.
So one of the criticisms, or perhaps not criticism, but critique that I've heard from a couple of talking heads on Twitter is, they sort of bring up the fact of, apart from the value add that they might bring to the retiring or aging owner or group or existing group of partners, that, on the business level, it's hard to kind of, bring the synergies and, maybe cost advantages. So, in your mind, what's the benefits to the business on an individual unit level when, Kelly Partners comes in and takes
Yeah,
a
so
controlling interest?
the unit economics of an accounting firm is there is the amount of partners in the business, the amount of employees in the business that aren't partners, the amount of admin staff in the business that don't bill in work, and then there's also like the gross margin is the profit per employee, but then there's also like WIP and debtors. So when employees work, they put down timesheets. The timesheets are set on like a charge out rate, which is like their hourly revenue per hour, basically. So you work 10 hours on a job and you're $200 an hour, then if you're recovering 100% of that, it's $2,000 bill. So that's generally how accounting firms work. And then, so what's really important here is your profit per employee. So you want them to be as productive as possible, as little admin staff as possible. And then you want to collect the billings as fast as possible as well. And you want to keep a lot of work going through the door. You want to keep very little work in progress. So like keep your WIP as low as possible, collect your cash as fast as possible, but at the same time, keep your employees as profitable as possible. So you do that by having less admin staff and then having this big gap between their wage and what they bill. So yeah, that's the type of all of those working in synergy together is what makes a good firm, like in a financial sense. Obviously, in a non-financial sense, you want to hit all your deadlines. You want to have happy staff. You want to have like low staff turnover because once there is definitely an element of efficiency for like long tenured staff. So if you don't have a lot of staff turnover, it'll be easier to hit all these financial targets. So that's important. Yeah, I think from the standpoint of Kelly Partners, they do all of that pretty well without any sort of outsourcing, which is really quite impressive. But it's driven by sort of the top. The top sort of sets these targets and they help them achieve them. From the perspective of an employee, it's kind of, admittedly, it was a bit frustrating for me because your interests are inverse to the success of the firm.
Sure.
Really,
Yeah.
yeah. Because profit per employee, you need to keep that as high as possible, but the employee wants a higher wage as possible. So it's those things are in friction.
Yeah.
But if you incentivize at the partner level where they're sharing equity ownership and getting profits from the equity rather than sort of their wage, then all the partners are aligned as well in that objective. So really the only person that might sort of lose out from that relationship is the employees. But but everyone at the top and the medium sort of level that are sharing equity, they're all aligned together. Yeah.
So it's kind of an alignment for the equity partners at the individual accountancy level. There's perhaps a freeing up of, making those admin costs as low as possible, and maybe even some industry know-how in terms of KPIs and performance and that kind of thing.
Yeah, and I would add another element to that is sort of how to keep your employees as productive as possible, but also keep them happy. There needs to be a strong element of like technical, like software use, like as much automation as possible, sort of keep them as productive as possible, but also paying them as much as you possibly can to be competitive in the market. So you need a lot of smart sort of software use to keep them, to get them as productive as possible, but not to sacrifice their wage. Yeah.
Okay, and potentially some of these accountancy firms that have been run by maybe aging partners or equity owners, they might not have that level of efficiency that Kelly Partners can bring.
Yeah, so this comes full circle, right? So you've got the succession focus, which you could spin it as if it was we focus on these firms because they're about to retire, but at the same time these firms also happen to be less profitable than newer firms because they're doing things in the Stone Age type of paper everywhere. So definitely some efficiencies to be had there. Cut out the number of probably like 10 printers in the office that they might have, and all this storage space for client ledgers and statutory filing. You could picture in your mind all these cost savings that you could do, but at the same time, deleting all that stuff and automating as much as possible gets your profit per employee up as well, which is the gross margin. So gross margin and overheads.
So in terms of the investment, I think I thought did you make the original investment in was it 2019?
Yeah, that's right, October. I actually made it on my birthday in 2019.
Many congratulations.
Yeah, best birthday present ever.
And so, what made it compelling then? Was it the low valuation? Was it a growth opportunity? What ticked the box for you to purchase the shares?
Yeah, well, I definitely say a bit of both for those. At the time, it was like a dividend yield of about 6% cash, but then you had the tax credits on top, so probably closer to 8.5%, which by itself is pretty good. And then accounting firm is a pretty slow growth industry, but a few percentages from pricing power. Like every firm can raise their prices a little bit every year. It's almost like a what's the word when all the competitors do at the same time?
Oligopolistic pricing structure.
Yeah. Everyone does that. So there's a few free percentage points from that, just raising charge out rates. But there's also just general referral, like client volume, which is very, very difficult, unless you're like a really sought after accountant, which like who is, unless you're breaking the law. Yeah, exactly. Like volume, like organic growth is hard to come by if you're not doing it via like raising prices a few percentages, or like what firms typically tend to do when they do organic growth is they expand their services. So they try to, rather than try to get new clients, they try to get more from the same clients. So yeah, that's the main method of growth. But then there's also acquisitions, which is it's such a large market that all the firms are doing acquisitions. So, at some stage, because there's not many barriers to entry to becoming a tax agent.
So maybe the initial purchase at a pretty attractive price in 2019. Obviously, there was the pandemic and the massive run up in the shares since then. But when did you sell the shares, and what was your rationale behind selling?
Yeah, so just obviously I held them from 2019 through to the end of 2022. But from my perspective, when I initially made the investment, I expected them to just stay in Australia, acquiring smaller firms for a long time, rather than make any concerted effort to expand overseas, which is, that was the red flag for me. I really did not like their intention to go overseas. I sort of thought that it brought a lot of risk, and it helped a lot to have a very healthy stock price, where I just knew that probably not the worst idea in the world to take some off. So I kind of just did that a few times. Like I only took about so at the peak of where it was in my portfolio, it was over 2/3 of my account. So it's huge. Yeah. So I cut that back down to about 40%. And then in the next couple of months, I kept finding new ideas and kept using that as a source of capital. So I didn't sell it into cash. Like I didn't make the decision, I need to sell the stock price now. Let's get out. No, I was comfortably holding it along the way, but alternatives came along, and I was just using it as a source of capital for new ideas. But yeah, to answer your question, international expansion, dislike that. That was and then a very healthy stock price.
Yeah, cool. Okay, so that was really interesting. I certainly hadn't gone into Kelly Partners as deeply before we chatted, so it's really great to hear. Another one that quite a few people were interested in was Australian Family Lawyers, which is ticker AFL on the ASX. What did you learn from that, and did that what happened with that company? Did that change anything in your process at all?
Yeah, so Australian Family Lawyers, unlike Kelly Partners, I'm not a lawyer. And I never worked at Australian Family Lawyers. That could be the reason for my lack of success in this investment. But basically, I invested in late 2020, so December 2020, and that was at a pretty high stock price, a lot higher than it is now. But that was an experiment in sort of like, there was a lot of growth going on in that company, and that was a bit of an experiment in paying up. Pretty bad experiment. But at the time, I was interested in the concept of optionality, and I viewed because they were acquiring other law firms at the time in December, they had made an acquisition of another firm, and they'd done it at about 20% of the year's sales. So a good law firm can get 20% margin in profit. So in my eyes, I was like, okay, they bought this firm at, they're going to get paid back in a year or less. So that was really attractive for me, and I'd seen that they'd done it multiple times in the past. But what I didn't focus on, like the unit economics in my eyes were like, this is the same as an accounting firm. How could it go wrong?
Yep.
But roll ups, and the management of that company was really quite promotional. So, in the unit economics of the company and the business and the partnerships, they were all great in my mind. And it was really good on their cash conversion, really good on their WIP and debtors. So same model, it's all good. And then what I didn't focus on was the parent company and what the management was doing. So looking back after the investment, like where could this possibly go wrong? It was biggest sort of standout thing that I probably should have focused on at the time was that corporate costs were really high. So like a rule of thumb is that companies of that sort of size, like sub 50 million, they shouldn't spend any more than 10 to 15% of their revenue on corporate costs, like in professional services specifically. But AFL was paying 20 to 25% in corporate costs, which is huge. It was basically taking all the profits and then some. And that was almost all in key management wages. So I was like key management wages and various Transaction costs adjustments. What are the other? Oh yeah. Anyway, you get the point. It was a top down management. But so that's where I went wrong. Definitely the management. I thought they were better than they actually sort of they were good. They were good at doing what they were doing, but they were really all right, we have to get paid as well. So
all the profits. Thank you.
Yeah. So that I definitely overlooked that part of the business. So
no, really interesting. Maybe we should apply for jobs at AFL. That could be a good
well, maybe a C-suite job. That might be a really good idea. Because they had a bit of agreement at the top where some of them were taking the CFO there. The CFO there, his name is Prat Yush. And he had I only learned this after the fact, but he was basically had this entity set up in India where he was getting some of the adjustments, transaction costs was actually going over to India.
Oh wow.
So that was a bit eye-opening, but
related party transactions.
Definitely sort of related party transactions that weren't reported.
Right.
Yeah. And then the guy that was on the board, who was from Google, was apparently a marketing whiz. I don't know what they were paying him for. So they had this whole thesis put out to the market that they were like we're the only we're the only law firm doing digital marketing, which is just, like they were doing some marketing, but it was nothing special beyond any other law firms. So, that's something I learned as well. Like, you take it with a grain of salt when they say they're doing, digital marketing, because I know I learned that some of the marketing expenses are going to him, but it was like, it wasn't actually doing anything. So,
Yeah, right. Okay.
yeah, it wasn't really paying off. So yeah, a bit overstated costs there, overstated costs on the management wages. Yeah, but it was definitely a problem at the top. So I'm very encouraged by the new management. So if Peter Johns from West Ferry is actually director now. And then Chris, I'm trying to figure his last name, but he was from Ashley Services, which is a HR firm in here in Australia. So they were a really successful turnaround story. So he's the CFO from that business, and now he's the chief operating officer and CFO at AFL. So that's pretty good sign. They've taken steps to make the balance sheet a lot more conservative already. And then, we'll see how they go the next couple of years, but if they can replicate anything similar to Ashley Services, then should be a very successful outcome. I actually, once they released the half year results and I got to see the full story, I invested a bit more in the company. And then from there, it has almost doubled. So I recouped a lot of my losses, but I don't own it anymore. So
you reckon you'd be interested in investing again if it keeps going sort of the same way and the valuation were to get attractive again?
Maybe I'll get to see some of the unit economics that were in my eyes at the start of the story. So, without the sort of baggage at the top. So that would be definitely, won't say no.
Cool. And the last question that we got from the crowd was, what's your highest conviction bet at the moment?
So, for me at the moment, I only own about 5 stocks, and then one of those stocks is close to 40% of my account, and that's actually Sequoia Financial Group. So it's here in ASX. It's another professional financial services business, which should be of no surprise. So what they do is they're really quite diversified, but in essence, what they do is they're a supplier to advice and accounting firms. So there's various different businesses under their umbrella that they that service advice and accounting firms. So they have a licensee business, which is called Interprac, and there's also another lot. They've got a few licenses. They got Interprac, Libertas, and then there's another one. Can't remember the name of it, but basically that business is pretty straightforward. What they do is they help advisors with compliance, and obviously you need an AFSL to provide product and financial services advice. So they hold the AFSL, and then advisors can be appointed by the licensee. So they've got about 300 and something advisors under their umbrella. So each of those advisors probably pretty $40,000-$50,000 per advisor in revenue. That's a low margin business though, but it's like also it doesn't really need capital, so that's a attractive point of it as well. But not amazing business. Really, like the good part of the business that I like is the professional services part. So what they have is they have an SMSF administration business, which is similar to Class. They probably use Class actually as a product. So what they do is they just do the annual compliance for super funds. Pretty straightforward business. And then they also own this business called Constitute, which is it's a legal business that puts out all the trust deeds and corporate constitutions. And those businesses, if you've ever used them, probably some of the best businesses you'll ever see, because it's all automated now. Well, when you order a trust deed or a constitution, you put in like maybe 5 lines of information, like contact details and a few numbers, and then it just spits out the deed automatically. So probably some of the best businesses ever now. That's a really good part of the business. They also have an equity markets division, so they have the special investments part of the business. I'm not really excited about it. Basically, it's like I don't know how to explain it, but it's this venture type thing for wholesale investors where they just give opportunities out. It's really not excited about it, but it just helps them raise capital, helps them get some media coverage. And speaking of media, that's the last part of the business. They acquired a few like financial news sites last year, and Share Cafe is one of them, and a few others. Again, not excited about this at all. Yeah, I don't think these are the major part of the business, but
Yeah.
basically, yeah, what they do is that they put out and pretty much allow companies to advertise their stock, pretty much. Yeah, through either through articles or through interviews, that type of thing. Yeah. And then what the opportunity is here is in the equity markets division, they used to own a clearing business called Morrison Securities. And they've been talking about selling that business for years. And then it's actually happened recently, which is when straight after it was announced, the stock didn't do much, even though what they're selling it for is $40 million. And the market cap before the deal was 65. So, almost 2/3 of the market cap there. That was really exciting to me because the stock price only went up about 8%. So it took a really, really big bet. And that was only accounting for about 2 million of annual EBITDA, and the group is doing, in 2022 they did 12, so it's only a smaller pie slice than what the cash they're getting in return. Yeah.
And in terms of that cash that they're getting from selling off Morrison's, what's the plan with that cash?
Yeah, so he's had a number of I guess there was a call about it, like an interview in their own financial news network where you could actually read about what they're going to do with it. So what the market thinks basically is that this deal is not going to go through because the person that's buying Morrison, they fell out in a prior deal due to a lack of funding. So Gary has reassured that they're very confident that they'll get the all of the cash that they're owed. But in really good structuring, that what they did was they put in this basically this fee where if they fail to make the deal, then they'll have to pay a fee to Sequoia, and then they take back the business. So they get paid either way, whether it closes or not. So that was pretty good. But yeah, so post the deal, they've got majority of the market cap in cash and still a good probably 10 million in pre-tax earnings.
So it's pretty cheap, just on even just a reported basis, and then you've got perhaps an asset realization, some cash coming in, either way.
Yeah, it was cheap before the deal, but then what they did, I didn't really answer your question before about what they're going to do with that cash, but what he wants to do is on a continuing earnings basis, he wants to move to 100% payout ratio. So before, just on a forward earnings basis, it's 20% earnings yield. So that's a 20% dividend.
Oh, wow.
So that was or maybe a high teens dividend. I don't know what the exact number will be when they get around to it, but that's a huge dividend just alone. But then they still have growing businesses, and then they have this big cash pile. Oh, sorry, it's a 20% yield on the enterprise value, not the market cap. So the market cap might be more 9 or 8, 9, but then they've got the big cash pile there. And then depending what they do with this cash, I think he wants to accelerate buybacks some more, which will be good to see. And then there's also talk of potentially acquiring insurance brokers. I'm not. Insurance brokers are a very good business. If you look at Brown and Brown, for example, that's a good business. But yeah, I'm not an expert on insurance brokers. So yeah, we'll see how we go there.
Pretty exciting opportunity, either ways, even just superficially. But that's great. So look, I think we'll kind of end here with a bit of a plug for the Substack and your Twitter. Where can people find what you're putting out online?
Yeah, so we'll start with Twitter. You can find me at hurdle_rate. That's the handle on Twitter. I'm pretty active. We'll see what happens with the new Substack offering. It's basically a Twitter client. But at the moment, pretty active on Twitter. And then you can also find a newsletter, which is partly paid and partly free, which is due to me not wanting to write for free. So what I do is I put out a fortnightly post, which is just a quick one-pager, might be 400 to 500 words on something I picked out of my watch list. So the last post, for example, was this accounting software business in Poland called iFirma. And the one before that was Shine Lawyers here in Australia. So, it's pretty varied. types of companies that come through those posts. But then for paying subscribers, what I do is every 2 months I'll do a deeper sort of analysis on a company. So just a week ago, I put out an analysis on an accounting firm here in Australia called Prime Financial Group. And then I also put out a quarterly portfolio update, which is really quite in depth, like a position by position analysis. Yep. And then maybe like some ad hoc posts about strategy and various updates. Yeah.
I've been a long time subscriber to the Substack, and it's very high quality. So the work you're putting out is pretty fantastic, and hopefully that remains as an avenue for us to put out content on the internet. Although you don't know.
Yeah, that's right. Not too sure.
Fingers crossed. Anyways, man, thank you so much for coming on, and excited to see where things go from here.
Yeah, thanks for having me. It's been a pleasure.